This is the CRE Weekly Digest by LightBox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Martha Kocher with our experts Manus Clancy and Dianne Crocker. For the week from July 14th to the 18th, investors sifted through a full slate of economic data and earnings reports to get a read on overall consumer and corporate health. Retail sales surprised to the upside. Inflation was muted, but did show that tariffs are starting to bite, and big banks delivered strong performance. But the news cycle was dominated by the Trump and Powell standoff over interest rates. Manus, the data released this week seemed like a Rorschach test, with analysts and pundits seeing what they seem to want to see. Where did you land?
I thought the data was puzzling, and the reactions remain puzzling when you take them in totality. When you look at the market sentiment right now, whether it's in the debt markets or the equity markets, we are certainly in a risk-on period right now. The NASDAQ hit another all-time high on Wednesday. It seems poised to hit another all-time high on Thursday. So certainly there's no tapping of the brakes on the equity side in terms of taking money off the table, reducing risk. When you look at the fixed income side, yes, treasury rates remain naggingly high, but when you look at risk premiums, for example, in the CMBS market, they are quite muted right now. They remain very range-bound and narrow compared to other periods of volatility, whether that be the oil bust of 2015, early COVID, or the period after Silicon Valley Bank failing. So you question yourself and you say, why is the market so complacent? Why are stocks hitting all-time highs? Why aren't bond buyers a little bit more discriminating? And I don't really have a good answer for that at this point. When you look at CNBC today, one of their headlines was the fact that home builders are cutting prices at the fastest rate in 3 years. We also know that higher tariffs are likely to come, even if the administration settles on only a 10% for everybody or a 20% for everybody. That is substantially higher than where we were a year ago. We already know that Treasury receipts are quite high on a month-over-month basis and a quarter-over-quarter basis in terms of what they're collecting on tariffs. So at some point, one would think there has to be a nasty surprise coming. Yet for right now, the markets continue to just soldier on.
I'll harken back to the point you just made, Manus, which is you said the data is puzzling, and I think that's true. And especially in the past week, you pick what story you want to believe. Some was glass half full, some was glass half empty. I'm here writing a market update that I'm delivering at the Environmental Bankers Association conference on Tuesday. And characteristic of our fast-moving news cycle now, I'm changing slides every day, whether it's a slide about the likelihood of a June interest rate cut. That essentially went to zero after this week's news. The bank earnings came out, and I'll quote something that jumped out at me from Jamie Dimon's comments at JP Morgan is he said, forecasting is a complete waste of time, ! And that inflection points are only visible in hindsight. And he's not wrong. I'll make a shameless plug here, too, for the LightBox mid-year sentiment survey, which is closing at the end of this week. And I took a preliminary look at the results, and I think they also reflect that people are confused. I think sentiment is mixed between folks who want to be hopeful, those who are pessimistic, those who recognize that we have a tough road ahead, as the impact of tariffs, which still remains to be seen, really start hitting the hard data on inflation. And commercial real estate, especially on the side of appraisers, is very much waiting and hopeful that interest rates will come down.
Starting about a month ago, I started putting out my thoughts for the week. It talks about what we saw on a micro basis, what we saw on spreads, what we saw on economic velocity. And thank you, by the way, to all those who have written into me off of that and have taken the time to read. But I said last week, one of the things that really stuck out at me is that we are on pace for $400 billion in tariff collections this year. something like $30 billion a month is the going rate right now. And that may increase, right? That may go to $600 billion if the administration plays hardball with some of these countries. Now, that's real money that's being sucked out of importers, yet we have not seen a meaningful uptick yet in CPI or PPI. So what does that tell you? We know that costs have gone up at a rate of about $30 billion a month. We know that somebody has to be bearing this cost. And from that, the logical conclusion is that either inflation is poised to go higher in the second half of the year because these costs will be passed on, or the importer is going to eat these costs, or the exporter, as the case may be. Somebody on either side of the ocean will eat these costs. And if that's the case, we should see some disappointing corporate earnings from those that rely heavily on foreign goods. And it could, of course, be a combination of the two. We see a modest uptick in inflation and some disappointing corporate earnings, but none of that has been discounted yet. Nobody, it doesn't appear on either the equity markets or the bond markets, is preparing for that moment where, for example, Best Buy says sales were down 20% in the quarter because we had to push the prices of computers and earbuds and everything else up, and therefore we didn't make our numbers. I don't think anybody is positioning themselves right now for that eventuality. And I don't think that's a 1 in 4 possibility. I think it's like a 5.5 or 6 out of 10 that we see something like that in the second half of the year.
Probably right around holiday season when we're all shopping for consumer electronics. That will be, who knows, 20% higher, 30% higher. We'll see. It's a good point. I mean, I do think that retailers are paying attention to the likelihood, but, I don't know how seriously they're taking it, to your point. Maybe it's too far down the road to be real. It's certainly a concern.
Listeners must be falling off their chairs right now because I think I'm known very much as a glass half full guy. And I've been very forthcoming on Twitter or in LinkedIn that the fact that risk spreads on CMBS have not blown out in the last 3 months since April 2nd. The fact that the CMBS market is on pace for a 15-year issuance high. The fact that lenders have not turtled and pulled back after the tariffs were announced. The fact that the LightBox Activity Index continues to trend up even now 2 months after the tariffs were announced. All of those are signs of a very confident market, and that has made me very confident. It has made me very bullish. You heard me say 2 or 3 weeks ago that I thought the second half would be great for CRE. Yet, more and more, I get this nagging feeling when I see these tariff receipts and I see what I would call overt enthusiasm for the markets, that there will be a moment of reckoning sometime in the second half where there'll be a better time to enter the market.
Manus, let's talk a little bit about the Trump-Powell standoff. And Trump waived a draft of a letter, supposedly. The New York Times said that there was a draft of Trump firing Jerome Powell at a meeting in his Oval Office, and he was gathering and polling Republicans to ask whether he should use it. And then about an hour later, announced that he wasn't actually planning to fire him. So that fueled a little bit of drama in the markets, but it wasn't long lasting.
In the hour or two when it was out there, certainly it was not beneficial for interest rates. We saw the 10-year spike 6 or 7 basis points in short order once this was out there. I do have this image in my head. I'm not sure if this will resonate with our listeners, but I have this image of the president running around saying, "Where is my stamp book? I need a stamp. I need to fire the Fed chair. Where is that stamp?" Right. And then just by the grace of not finding the stamp book, we have Jerome Powell still in the Fed chair position. I don't know. The whole thing is just unfortunate. I think it's a case of the administration creating its own drama and its own distraction. There are some things out there that are very important right now, and there are some successes that the White House can point to. They could point to the fact that they got their bill over the finish line. They could point to the fact that one of their goals of reducing the flow of immigration has been met. I think when you get to this 3 o'clock high, right, meet me on the playground at 3 o'clock so we can, wrestle. I don't think that's is dignified or necessary.
Yeah, and it definitely distracted from the inflation news this week. Imagine doing your job and finding out the president wrote a letter that your termination was imminent. And I think it's more than political theater. It's kind of a test of the Fed's independence. And we saw with the market reaction how the threats really, alone, the threats rattled markets. They highlighted how fragile trust is in central banking. And Trump just keeps rattling that cage, and I kind of wondered, Manus, like, who would even want that job? I mean, what if we are heading into kind of 70s era inflation? I mean, who would want to be Fed chair? And now to your point, what happens? He thinks, okay, I can only let him go if there's fraud involved. So now he's shifting the conversation to talking about a $2.5 billion renovation on the Fed's building, saying, I don't rule out anything, but he said, I think it's unlikely that he has to leave unless he leaves for fraud. So it's maybe a red herring that will shift attention away from other more material issues, as you mentioned.
I do think that the president actually is in control of his own destiny, not in terms of firing the Fed chair. I think most people are in unanimity when they think the president doesn't have that right. But he does have the ability to cut deals faster on tariffs, to take the tariff risk off the table. And I think that tariff risk, that inflation driven by tariff spike, is what's keeping the Fed from cutting rates right now. So in some ways, the president does have his own destiny in his hands. If he can cut deals with China and India and Japan and other places very quickly and say, here's the finite number, it's done, the Fed can go back to their job of saying, okay, that risk is off the table. Let's now start talking about the right level of interest rates going forward. So it's kind of unfortunate that we've gotten into this level, but you do have to ask yourself, right, at some point, does the president become, the case of the tail wagging the dog, right? There's two scenarios here. One is you bully the Fed chair into cutting rates. When we saw a 100 basis point rate cut last year, the financial markets didn't respond positively. We saw the 10-year Treasury rate spike 100 basis points, right? That was not favorable to long-term interest rates. And there's no guarantee that if we pick a new Fed chair, that new Fed chair cutting rates wouldn't have the exact same impact. It's quite possible that could happen. By the same token, we could really use lower rates in terms of refinancing our government debt. We have a lot of maturing debt coming up. So again, a more dignified and more constructive conversation between the two, where you talk about where tariffs might ultimately come up and talk about trying to save Americans some money by cutting interest rates on the short end, that would be productive.
That kind of brings up a point related to your previous train of thought with tariffs, on whether the market is really being honest with itself about where that could lead in terms of pricing, in terms of the impact on retailers. Maybe the collective response to, call it, the tariff ping pong that we've seen back and forth is just folks watching and thinking, well, there's still a chance that we could strike a deal with China, that, we could strike a deal with other importers so that tariffs don't seem real yet. And I think the copper news maybe hit hard, especially on the construction side, as something real, as, okay, these rates could go up by X percent. So we have to get serious about what that does to our numbers, the calculus behind development projects. So I think it's a process of folks watching and waiting until things kind of shift from the abstract to the real.
Let's turn to our LightBox data dive. Our lender appraisal market snapshot is about to be released. Dianne, what did it show?
So the report looked at second quarter numbers from lenders who are using LightBox's Collateral 360 and RIMS platforms. So in the second quarter, commercial real estate lenders put 18,114 appraisal assignments totaling $62 million out to bid on our platforms. That was a 6% increase from the first quarter. It was 14% up year over year. I will say that the month-to-month flow was a bit uneven, and I think that's really a sign of the growing caution in the market as they react to the volatility that we saw, especially in April, May, and June. By asset class, we saw strong activity in retail and industrial. Collectively, those two categories made up 42% of the quarter's appraisal volume. So that was a sign that lenders are chasing deals in asset classes that they perceive as lower risk. Industrial certainly is at the top of that list. Average fee per lender project climbed for the third straight quarter. That was up 7% year over year to $3,437. Turnaround time improved to 14.1 business days, so that was a little bit faster. And it's well below the 18-day average, which is what it was in early 2022 when there was a lot more projects happening at the market's heyday. And then last, I'll say preliminary results from the appraisers who responded to the mid-year market sentiment survey that I mentioned earlier showed that 39% of appraisers are somewhat more optimistic about the outlook than they were at the start of the year, and 29% are slightly more pessimistic. So glass half full, glass half empty, they're leaning a little bit more toward the optimistic side. So I think second half of the year will be telling. If lending demand holds, then I think appraisers can relax a little bit and expect a steady stream of orders. But if volatility spooks the market, I think the pipeline could be a little lighter. I'll note just in closing, one appraiser I talked to recently said, look, our market hates unknowns, and it's so hard to act with certainty when we're operating under conditions of such uncertainty. So the quarterly report is coming out next week, and it'll have more details on all of those numbers.
I wouldn't want to be an appraiser right now that has to kind of put a number on what he or she expects expenses to be in the future with this kind of uncertainty, what supply costs, janitorial costs will be. And when you get into that construction side of the business, when somebody's buying land with the idea of developing something, I wouldn't want to be the guy trying to make something pencil with such an opaque market right now when it comes to how much things are going to cost and how long this inflation may last for supplies. It's challenging.
Our Did You Know for the week, Dianne, takes us to our June deals.
Yes, our blog just came out analyzing big deals in June. We have a 6-month trend in 2025 of pretty steady growth in major transactions. So we look at deals that are over 9 figures, and then we also look at deals in the $50 to $100 million bucket. And it was in that middle bucket where we saw a 46% jump in June from 37 deals in May to 58. 9-figure deals ticked up too, but not at that high of a percentage. But I feel like that kind of rebound really said a lot. Investors, they're finding pricing clarity when they can. Confidence is cautiously returning, even with all of the macro noise and uncertainty that we've been talking about here today. And multifamily continued to dominate. That accounted for 18 of the 9-figure deals in June and 15 of the mid-size. So that makes multifamily the top performing asset class for 4 months running. The June deals analysis just went live. So if you want to break from the drama in DC, take a look.
Let's shift into some big transactions. Firms are doubling down on warehousing in the industrial space. And let's start with Brookfield. Despite a cooling warehouse market, they've acquired a $428 million portfolio.
That was one of several really big industrial sales that have taken place over the last 2 weeks. We haven't talked about transactions a lot in the last couple of weeks because we've had some really terrific guests on the podcast. So we'll go through some of that today. But the Brookfield deal you're talking about is a $428 million portfolio of 53 smaller format industrial buildings. This covers the Dallas, Houston, Atlanta, Nashville markets. The portfolio spans 3.6 million square feet, is 96% leased, but it is only one of, as I said, many industrial sales that took place since July 1st. So we talked about that first one, Brookfield Asset Management buying the portfolio from Stone Lake Capital. Another big one earlier in the month, a 2.7 million square foot portfolio in Raleigh, Durham. that was acquired by Town Lane from Corbridge. There, $261 million was the price for 2.7 million square feet. So in the case of Brookfield, $119 a square foot. In the case of Town Lane, $97 a square foot. You also had a 6-property Ohio industrial portfolio. This was in the Cincinnati area, $193 million. That was done at $99 a square foot. Plymouth Industrial REIT buying that from Dalphin. In New Jersey, we had a pair of properties sell in Avenel, New Jersey for $140 million. And in Manteca, California, an industrial property for $106 million. So lots going on in the industrial space. And maybe, Dianne, next month will be industrial's time to knock off multifamily as the leading grower in terms of big sales numbers.
It could be. I mean, a lot of the metros that you mentioned, those are Sun Belt industrial markets. There's a real boom down there now. There's a flight to quality, and there's definitely a narrative kind of taking shape in institutional commercial real estate activity. I mean, Brookfield has $106 billion in dry powder that they're ready to deploy, and over 75 million square feet that's now under management across North America. So they're definitely emerging as a major player. And I think for other industrial investors, they're watching to see where folks are investing, and they're going to be out there looking for similar deals while the getting's good. So we'll see if industrial knocks multifamily out of the top seat.
I have to say, I'm surprised. I'm a little surprised at how buoyant industrial remains. Really, this has been a 7 or 8 year rally for industrial, starting with the e-commerce wave that started 2015 or so. A lot of retailers moving their businesses like Macy's out of bricks and mortar into a more e-commerce centric. We certainly saw the transition go into steroid mode during early COVID, right? When people just wanted to e-commerce everything. The uptick in value per square foot of industrial really took off. But I have to say that for the last 18 months, I've been thinking to myself, eventually this market has to be saturated. There has been so much new product put on the market over the last 5 years that at some point it has to run out of steam, but yet it never seems to. It's the big engine that could, so to speak, to paraphrase the children's book.
You know, one thing to think about, Manus, is if folks are listening to you and they're starting to get nervous about prices going up, what does that mean for industrial? What does it mean for warehousing? What does it mean for self-storage? You know, what if people start to stockpile goods in advance of prices going up? I say that flippantly, but I want to highlight 2 other stories that I think speak to the point that you were just making, that warehouse is becoming a hotspot. One was Ford City Mall, flipped from shoppers to shippers. Bridge Industrial pitched a $150 million mall to warehouse property. Ford City Mall was once the largest suburban mall in Chicago, and it's slated for a pretty dramatic transformation. Bridge Industrial entered into a contract to buy the retail complex. It's 960,000 square feet, and they are buying it from Namdar Realty, and they're not planning a refresh of the mall space. They're planning a full teardown. They're demolishing this mall, and they're redeveloping it into a $150 million 4-building industrial campus, 92 loading docks, 1,000 parking spaces, and it's infrastructure that's optimized for last mile logistics. So there's an adaptive reuse story that really, you know, speaks to the demand for industrial space.
That's an interesting one on several levels. The first one is Namdar has been a very active buyer of distressed malls, usually with the idea of buying them, running them until the tank is empty, right? Just taking whatever profits are out of there, not investing in it at all. And often there has been a wave of optimism when Namdar comes in, people thinking, oh, this old depressed mall is going to get revitalized, but then it never does. So that's one part of the story I find interesting. I'm sure Chicago is thrilled that they are replacing Namdar with somebody who's going to put some money into this project. That's great news there. The other thing I was thinking about with this is Martha and I used to do podcasts periodically with a gent called Darren King years ago, and he would say the mall to warehouse transformation is the dog that never hunts. People always talk about it, but it never really comes to reality. So, Darren, if you're out there, if you're listening today, here's a dog that is hunting. We have a mall in Chicago that's going to go from depressed retail to warehouse. So we'd love to get your thoughts on that if you happen to listen.
And there was another warehouse headline this week, too, that I wanted to mention is Prologis was in the news. They are the world's leading industrial REIT, and they are sprinting out of the blocks in the second quarter. They launched over $900 million in new warehouse projects. That was nearly triple last year's pace, and 65% are already pre-leased before they even lay down a single brick. So Prologis, I would say, is extremely bullish on the warehouse market, and their founder and CEO, he didn't mince words. He called it the strongest demand that he's ever seen in his career.
So a note to our listeners, ignore my skepticism. Listen to the guys at Prologis. They are the ones who are beating the pavement every day. They know this market 100 times better than I do, and I would find them a much more trustworthy source for where the market is going. A couple of other points on their earnings, which were released this week. Funds from operation, FFO, up 9% from the same quarter in 2024. So a nice 9% uptick there. Overall occupancy, 95.1%. That's nothing to sneeze at as of the end of the second quarter. And their leasing pipeline hit a record of 130 million square feet over the last couple of weeks. So everything seems to be going in the right direction for Prologis, which is a very, very good sign for the health of the industrial space.
You know, Manus, another huge headline this week that got me raising my eyebrows was Blackstone announced an investment of $25 billion in developing not just data centers, but data centers and power plants in Pennsylvania. So they're looking at co-located projects across the state. The idea that you can co-locate a data center directly next to the source of power. So that's what their CEO called the special sauce, being able to put those two things together.
Well, that's the value of working with a state that is open-minded about doing new things, right? Pennsylvania, one of the first states to embrace fracking. Right next door, New York State has resisted fracking for a long time. So really no surprise that when it came time to plan these new developments, that Blackstone opted to go to Pennsylvania, right? You have a favorable political climate and an area where oil extraction has taken place before. So makes sense.
You know, and locating these huge data centers, I mean, from a zoning standpoint, from a planning standpoint, it gets very complicated in finding cities and locations where there is available infrastructure for the electricity inputs that they need, you know? So Blackstone here isn't just financing AI, they're building the backbone that they need to support it. It's, you know, it's infrastructure as a service, and it could serve as a global model for scalable AI infrastructure deployment.
Let's talk about office. Last week, Dianne, you talked about the big pink office tower, and the story of its purchase hit the wires in the last couple of weeks. Let's talk about that one.
Yeah, that one caught my eye. I like this story because I got to visit Big Pink in Portland for a conference last month. This is a headline about an iconic building. It's called Big Pink because it's got rosy siding. It is the second tallest building, not just in Portland, but in the entire state of Oregon. And U.S. Bancorp left it as the major tenant to move their headquarters to the suburbs. So vacancy spiked, and it just sold in an all-cash deal for $45 million. That's an 88% markdown from its 2015 sale of $372 million. Buyer's Jeff Swicard. He owns an auto dealership chain in Vegas. He's spending another $150 million in renovation. He's talking about multi-floor experiences, fitness centers, restaurants. I did learn that he cannot open a Las Vegas casino there because casinos in Oregon can only be run on tribal lands. But what I liked about this story was that The buyer went to college in Oregon, and he's on a mission to bring people back downtown. So I wish him well. I think Portland's a gorgeous city. It's got a lot to offer. This building it's really beautiful. And I think if he succeeds, it will be good for other office buildings in Portland as well.
Two big headlines out of the big pink story. One is the very positive one that you mentioned, Dianne, which is that $150 million investment. Anytime somebody is going to lean in on a distressed office property in any city, it's a positive headline. We love that. We love when people are putting money to work and trying to lead cities out of office distress, which is really the name of the game in many major U.S. cities. So that's one headline. The negative headline is, sadly, it's of a piece. We don't see too many that have 88% discounts, but we see plenty that are still 40, 50, 60%. Just last week, here are a couple that we saw in Washington, D.C., 1625 I Street sold for $60 million. That was down from $260 million in 2019, a 77% discount. In Houston, Broad Hollow Central sold for $58 million. That was a 17% discount from a 2018 purchase. In Phoenix, the Camelback Collective sold for $48 million, a 27% discount to the 2022 price. So only 3 years hence, a 27% loss. And in Atlanta, the Palisades Office Park sold for $47 million. That's a 61% discount to the 2018 price. So if there's one commonality to all these sales that I highlighted, it is that we're seeing still big discounts to the prices for offices from just 5, 6, 7 years ago.
There's still room to run in terms of office finding its bottom. And for the appraisers that we talked about out there, each of these deals gets them a little bit closer maybe to comps that they can hang their hat on. But if you look collectively, Manus, at the stories that you're uncovering, there's a lot of divergence in terms of the comparison between the prior sale price and what it's going for now. So it certainly, I think, makes appraisers' jobs harder when things are all over the board. And at the same time, waves of transactions help sectors find their floor, but office still has some ways to go on that front, clearly.
But when we talk about wagering, you were talking about turning Big Pink into a casino, which is a no-go. There was one happy headline in Denver, Colorado. One Plat, which is a 249,000 square foot office in Denver, sold for $135 million, almost $550 a square foot, acquired by one of those online gambling companies, Bet365. So those companies seem to be minting money right now, and Bet365 putting their chips on the big office tower in Denver.
Well, Manus, speaking of bets, Delta had their earnings, and they're saying that by the end of the year, 20% of their ticket prices are going to be individually determined using AI. So they'll have a price that's available on that flight, on that time to you, the individual. Some say they're kind of seeing into our heads about how much you're willing to pay. Right now, only about 3% of fares use AI pricing. So, Manus, knowing that you liked shopping at Kohl's, what's that say about what you're willing to pay for a flight?
Here's where I see this going. For years, I've always said, and this is not a tinfoil hat remark, this is real, that I will be talking to my wife about hockey, for example, and then 20 minutes on my phone, ads for tickets for a hockey game will start popping up. So there is this knowledge out there that what I'm doing and what I'm looking at, what websites I'm surfing are being known, are being trafficked somehow. And I can only imagine that someday I'll say to myself, wow, I want to go see the Giants out in Las Vegas. I'll call my brother, we'll get tickets. And somehow every airline will know that I've already spent $300 on football tickets. And they will say, there's the guy that we got to hit for $700 a seat, because he's not going to forfeit these tickets, right? He's not going to go.
I have had those same experiences where I feel like my phone is reading my mind. And when they put those deals in front of me, I'm mostly grateful because it saves me the trouble of Googling, but this makes me a little nervous.
And we'll see how it goes. Thanks to our producer, Josh Bruning. Please join us every week as our Lightbox team shares CRE news and data in context. If you like what you hear, subscribe and rate this podcast and send your comments or questions to podcast@lightboxre.com. Thank you for listening and have a great week.
Let's go.